wondered, how are Bursa Malaysia's marketplace being monitored? Would you like to know how the marketplace is maintained orderly and fair? Welcome to Bursa Malaysia. We are the frontline regulator of the equity and derivatives markets. So, what does this mean for you? Through Bursa Malaysia regulation, we ensure the markets you invest in are orderly and fair, so that you have timely, accurate, and complete information to make informed investment decisions. Are able to trade in a fair and efficient environment. Have confidence in your brokers to provide secure and trusted services to you. So, how do we protect the marketplace? We have multidisciplinary teams in Bursa Malaysia regulation that focus on specific areas while collaborating with each other to provide a comprehensive network of safeguards for investor protection. We also work closely with other regulators and law enforcement agencies. Real-time surveillance of the market. We have a market surveillance team that acts as your market police. They monitor the stock market against irregular trading activities in day-to-day trading. This team uses an automated surveillance system to monitor trading in the equity and derivatives markets in real time. Should irregular trading activities be detected, this team of specialized analysts will fact-check and engage the brokers involved for their immediate action. Supervision of intermediaries. As safeguarding the integrity of the marketplace is paramount to us, our intermediary supervision team secures the protection of your trading and deposits through consistent broker monitoring and inspection. Disclosure. Continuing listing obligations and gatekeeping of listed companies or products. To be ASEAN's leading, sustainable, and globally connected marketplace, Bursa Malaysia places high emphasis on the quality of our listed companies. This begins from the approving of new listings on the exchange, through to ensuring that listed companies remain of quality through governance and compliance. As it is imperative for investors to be well informed in the fast-paced financial world, Bursa Malaysia regulations listing and corporate surveillance teams monitor companies' corporate announcements so that they are disseminated to you in a timely and accurate manner. Enforcement action is taken should there be any failure to do so, or should there be any material inaccuracies to the announcements made. As we are also a venue for listed companies' secondary fundraising, our relevant departments work together to ensure investors' funds are always used as mandated. We have a dedicated team of finance experts to examine corporate disclosures, including financial reports, so that they are accurate and timely that you can rely on. Within Bursa Malaysia regulation, we have subject matter experts that look at the various international sustainability reporting frameworks that are constantly evolving to ensure that our disclosure requirements are appropriately benchmarked. This ultimately drives the desired improvements in our PLC sustainability disclosures as well as practices. Taking enforcement action. So what happens when the persons are regulated by us? Be they brokers, advisors, listed companies, directors, or their representatives, breach our rules. Appropriate action will be taken against them. The types of action taken would depend on the severity of the breach. Suspected breaches will be investigated, and enforcement actions will be taken if the breach is proven. Our enforcement proceedings and actions are consistent and fair as cases are discussed in a robust manner through our regulatory committees, comprising independent individuals with relevant experience and backgrounds. Policy and rulemaking. Bursa regulation is the guardian to the 10 rule books of the securities and derivatives markets. Rules drawn up by the regulatory policy and advisory team are always outcome-focused. Industry or public consultations with the relevant key stakeholders will be undertaken, alongside rigorous benchmarking processes to ensure the rules are relevant, effective, fit for purpose, and on par with international standards. Each multidisciplinary team in Bursa Malaysia regulation is intertwined and interact proactively to ensure high standards in market integrity.
Hi everyone. Welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChat. My name is Atira and I will be the moderator for today's session. Our title today is IETF, Investment Strategy During Volatile Market. Think you need a lot of money to gain a diversification to company across sectors? Not really. Exchange traded funds, ETF, can help you gain instant diversification to different sectors and asset classes at a low fee. So, today, we are honored to have Ms. Asna Arshad to share with you her insight on how to leverage IETF to build wealth, navigate market volatility, and invest smartly even with limited funds. Before we proceed, allow me to make a short disclaimer. Please be reminded that everything that is shared in this session is mainly for educational purpose, and by now, no way we are providing you advice to buy or sell any securities. You are 100% liable if you make any investment decision. Now, allow me to briefly introduce our esteemed speaker for today. She is none other than Ms. Asna Arshad. Ms. Asna Arshad is a licensed financial planner, trainer, and translator. She is a licensed financial planner regulated by Security Commission. She also holds a certified financial planner mark and registered member of Financial Planning Associate of Malaysia. In addition, she is a HRD Corp certified trainer and has a bachelor degree in translation and interpretation from University Science of Malaysia. Currently, Ms. Asna serves in Philip Wealth Planner Sidian Berhad as a wealth planner. With that being said, let us warmly welcome Ms. Asna to the floor. Good day, Ms. Asna. How are you today? I hope you are doing well.
I'm good. Thank you, Atira, for the introduction. So I assume that I'm going to take over the session. Hi, everyone. Good afternoon. Good evening. Thank you for checking in to the webinar. I know some of you might just came back from the work. So, and it's in the middle of the week. So I really appreciate your time. So before I introduce myself, may I get to know some of my audience? So who is it here that first time hearing about ETF? Like before this, you haven't heard of ETF. So if you are newbie in terms of investment in ETF, may I have a show of A? Like, you know, everyone type A if you are new in ETF investment. All right. All right. Okay. So if let's say you are an experienced investor, meaning that you have invested before, but you are looking to diversify in ETF investment, may I have a show of B? All right, so some have experience in investment and are looking for alternative or, you know, a way to actually diversify in investment. All right, good. Okay, so based on your response, some might, I will actually try to paste the presentation so that the new one will actually understand, and the experienced one will actually gain something at the end of the day. So let me share my slide. All right. Right? Okay. Here we go. So what is ETF? So what is the difference between ETF and IETF? So ETF is exchange traded fund and IETF is Islamic exchange traded fund. So you our today's presentation is basically everything about Islamic exchange traded fund. So some those who are familiar with ETF might not might notice that some features in ETF conventional. No slide. Tira,
Yes.
there's no slide, is it?
Yes, there is slide here. I can see the slide.
You can see the slide.
Yes.
Some of the participants doesn't see the slide.
Some of participants
Mm.
cannot see the slide.
Maybe you have to. Yes, Sharif. Maybe the one that didn't see has to because I have two. Yes, Mr. Chu. I stands for Islamic, right? So I will actually explain what is the difference between Islamic exchange traded fund and exchange traded fund itself later and in the middle of the presentation. All right. So next. So what is ETF and how does it work? So basically, an ETF or Islamic Exchange Traded Fund is an open-ended investment fund that tracks the performance of specific underlying asset, be it an index, commodity, or under suitable underlying security. So it has two features. ETF has one feature number one, which is it traded like stocks, where you can buy and sell Asian traded fund just like stock in real time. Let's say, for example, the Bursa market open at 8, then you can actually buy and sell at the real price. So while mutual fund or unit trust, in Malaysia we call it as unit trust. So ETF also like a mutual fund or unit trust, as you are familiar with, because in a fund that you invest in ETF fund, one fund will actually, you are buying a diversified fund, meaning let's say you buy an ETF of equity. So what you are buying, not a single stocks, but you are buying a diversified stocks, depending, either it can be diversified in sector, it can be diversified in geography, it also can be diversified in asset allocation. All right. Okay. So for example, let's say an ETF in that called ETF S&P 500. So what they are buying is basically they are tracking the indices or one of the index. So in Malaysia, let's say FBM KLCI. So the fund that track FBM KLCI is actually the stock is similar like 30 largest companies in Malaysia. So they are investing in 30 largest companies, similar like FBM KLCI. And the thing is, usually in a unit trust fund, the fund manager will actually try to outperform the benchmark. So their KPI is actually to outperform the benchmark of the indexes that they are tracked. But exchange traded fund does not do that. Usually they just mimic or copy the index itself. One example is, let's say, Vanguard S&P 500 ETF track the S&P 500 index in US. So the characteristic of ETF is, one, it is traded like a stock. Two is the fund is diversified like a unit trust. And three is the characteristic is it track the indexes that it follows. Okay. So why do people invest in ETF? So there's usually mainly there's two people that usually invest in ETF. One is those who are newbies that doesn't know how to actually choose the stocks. I mean, they are interested to start investing, but they don't know where to begin. They don't know how to choose. So the investing in ETF, in Islamic ETF or in ETF itself is a safe, is a good starting point for them to invest. Or they can also be an experienced investors like some of you guys, but they don't have time to actually manage the fund because they might not have the ability. They might have the ability to actually analyze the fund, but they don't have the time to actually monitor the fund or monitor the portfolio. So they use ETF actually to rely on the fund manager or to actually choose the company's stocks that is performing at that particular time. So either you are investor A or investor B, newbies or experienced. So choosing to invest in ETF is because diversification makes simple. Because how much is the charges? Any annual management fees? There are, but very low compared to investing in unit trust itself. I will touch on that. What is the difference between ETF, stocks, and unit trust? I will touch. Oh, sorry. So if you have questions, you can just type in the chat box, and I might actually answer over the period of the presentation, or I might actually answer the questions at the end of the presentation, whichever that is convenient for me. All right. So, okay, the first one is diversification makes simple, meaning that one, you invest in one. I will show you what kind of Islamic ETF available in the market. But let's say, for example, you are investing in 50 Dow Jones. So you are investing, the moment that you're investing, you have access to 50 companies in the fund itself. All right. And then the second one is it has lower cost compared to unit trust. Like the question asked by the participants. So they are generally passively managed, but they still have fund manager, and they have lower management fees. Stocks doesn't have lower management fees, but unit trust have, and they are lower. So the unit trust, usually they will have about 1% of charges, but for ETF it is much more lower. And in terms of liquidity, ETF is also liquid because you can actually sell and buy the stock as you can buy or sell the fund similar like the stocks, whereby you can actually buy, let's say tomorrow, Friday, you want to buy, you can actually buy immediately. And then if you want to sell, you can also immediately sell, and then you can actually gain the profit if you are selling for profit within T+2 or T+3, right? And then liquidity, as long as there's a buyer or seller, you can already access. And in terms of flexibility, it is much more flexible because you can do on your own on the platform. As compared to unit trust, you might need to actually go through an agent. If let's say you have an agent, and then you have to actually do transaction with the agent and sell. Say I want to sell, and the agent will actually create the transaction, and then you have to approve. So which is actually take time compared to an ETF. Transparency, in terms of transparency, ETF is also transparent because you know exactly what you are buying. You can actually access, you know the fund that you are buying at a particular time, and you have access to local and global market depending on which ETF fund that you actually selected. And the last one is it is adaptable to any strategy. What I mean strategy is because you can actually choose a strategy based on your risk profile, whether you want to go aggressive, whether you want to go moderate, or whether you want to go conservative. ETF have the fund to actually suits to your risk appetite. Now, we talk about the advantage of investing in ETF, and we didn't talk about the return yet. But a lot of people, when investing, all they think is about getting return or getting profit, but they forgot about the risk involved. So what is the risk involved in investing in ETF? The first one is the market risk, because it is similar like investing in stocks. So there is a market risk. So if there is any market crashes, so it will actually involve your performance in ETF. It will also affect it as well. So if let's say there's a decline in KLCI, if let's say you're investing in ETF FBM KLCI, so if let's say there's a decline in FBM KLCI, your ETF will also affect it. The second one is sector concentration. Some ETF might be focuses on one commodity. Let's say you are investing in ETF gold. It's a commodity, so it's too concentrated on one commodity. So if let's say gold prices drop, all your portfolio, without a portfolio, all your investment will actually drop as well. Currency risk, there is also, because some of the investment in ETF is actually abroad. Let's say you're investing in US or you're investing in China. So and investment in China or US might involve in renminbi or US dollar. So there is a currency while you are investing in Malaysian ringgit. So the company is in US dollar. So there is a currency in terms risk in terms of foreign exchange, because there's a differences when you buy and when the market depends on the changes of currency. So liquidity risk. So liquidity risk, there is a liquidity risk if let's say there's not enough buyer and seller. So if let's say the ETF is not popular enough, there's not enough seller at that particular time or not enough buyer. So there is a liquidity risk if you want to sell and then there's no buyer. So there is you might have problem buying or selling at the fair price. You might have to sell at lower price. Okay, tracking error. Okay, like I said, it's tracking an index. So maybe due to a delay in the system, so there might be a tracking error. The next one is Sharia adjustment. So Sharia adjustment, because this is Islamic ETF, so there is additional assessment, which is the stocks that we are buying must comply to the Sharia principle. So sometimes when being audited, the company that is in the list of the stocks does not meet the Sharia aspects or the Sharia requirement. So that company might be taken out from the fund and might affect the performance of the fund overall due to many various reasons, which I will actually share. How do they actually screen the Sharia requirement, Sharia aspect in Islamic ETF? So if they don't meet, then there is a risk that you might not achieve the targeted return that you are hoping for. And the last one is operational risk. So there are management. So if let's say the fund is or the company has problem, either mismanagement of the fund or the change of leadership in terms of the in the company that you invested. So that is a risk that you might face. Let's say previously they have a very good leaders, very insightful, very vision forward. So and then they change, maybe they change to the new leadership, maybe based on political appointment, so might not have the experience that needed to actually manage so the company well. So the performance might drop. So there is a risk involved when you're investing. So the next, okay. Next is what is the difference between ETF, unit trust, and stocks? So the difference is, the first is real-time trading and market pricing. So unit trust usually is not, you don't get the price for today's price. Usually most of the time, the price that you are buying is actually yesterday's price. Okay. But ETF and stocks, the price is a real-time price. Whatever that you are buying or selling at that time, that is the price that you are selling. So it might be different morning, might be different in the afternoon. So you know the pricing is a real-time pricing. Investment diversification, okay, with 1,000 ringgit, for example, or you might have a diversification in unit trust. You might have access to 10 companies or 20 companies at one particular fund with 1,000 ringgit. Similar like yes, ETF as well. Yes, they have an investment diversification. You can even choose which diversification that you want, either geography, sector, asset allocation. But stocks, you cannot. You usually with 1,000 ringgit, you can actually buy 1 or 2 company at one particular time. Okay. Usually one transaction. So transaction for investment in unit trust is usually through agent, or now they have online platform, but you have to go to one. You have to go to an agent or a online platform right now. While ETF, you have to go through broker. Sales charges, unit trust have sales charges depending on what kind of fund that you actually investing. So lower risk, for example, like a sukuk or money market might have a lower sales charges. But for higher like equity or mixed investment, they might charge you 3 to 5% for your investment. While ETF or stocks doesn't have sales charges. So investing, let's say for example, again, you're investing 1,000 ringgit with 5% sales charges, 50 ringgit will go to the sales charges. So you are not fully invested. Your capital is not fully invested. While ETF and stock, your investment is fully invested at that fund that you choose or your stock that you choose. So broker commission, clearing fees, stamp duty, unit trust don't have it. ETF have it. Stock have it as well. Management fee, unit trust have it. ETF also have it, management fee, but it doesn't charge you on your capital. It's already included in the NAV price. So when you buy at that price, the management fee is already included in that price. So stock doesn't have management fee. Listed on exchange, yes. Sorry, unit trust it's not listed in the exchange. ETF and stock is listed in the stock exchange. All right. So now, what is the difference between the conventional exchange traded fund and Islamic exchange traded fund? So basically, it is usually what we hear is Sharia compliant. So what is Sharia compliant? So one is for the index Sharia compliant, it only tracks on Sharia compliant indexes. But conventional ETF can actually track any chosen index that they choose. But Sharia compliance, they have to actually follow. It's like, let's say, for example, for gold, they have to actually go index with Sharia gold index. Okay, so underlying security, meaning that the asset they are investing, for Sharia compliant ETF, they must be consist on only on Sharia compliant stocks approved by the Sharia advisors. At the company level itself, they have Sharia advisors, and regulatory level also they have Sharia advisors. So they have to actually comply both at the company and also at the Security Commission. While conventional ETF consists only of stocks listed on stock exchange and selected by fund manager. So they are free. They can choose any. use of synthetic stocks. So use of synthetic stock is not allowed in Sharia compliant, while conventional is allowed. So what does it mean by Sharia? By synthetic stock is actually synthetic stock. Synthetic ETF is actually rely on derivative. It's actually contract based. It's not asset based. So on the future value of the assets, like commodities in such cases, investors don't own the underlying asset. So, but merely they are actually focuses or investing on the future value. So that is the, if you understand in Sharia investment, it has to avoid three aspects, which is riba, masir, and gharar. Gharar is something that you don't know, something that you're uncertain. So when you are investing in future value, you are uncertain what will be the value. So that is actually not permissible or not allowed in Islamic investing. Okay. Sharia governance, yes, as I mentioned, if let's say you choose and to invest in ETF, you can look at the fund fact sheet. So there is in the fund fact sheet mentioned who is the Sharia advisors for that fund, and that Sharia advisors is accountable or is the one who actually to ensure that the stocks that is selected is must be Sharia compliant. Not okay. Let me. I'm not really. I don't invest in. I don't use warrants. So I'm not really familiar. But let me check. Okay. So Sharia screening aspects. There's two type of screening aspect that they check when they are investing. The first is the companies. So the companies in Sharia investing must not be financial service based on interest. It has to be on profit based. Because based on interest will be considered as riba. The company involved must not be a company that involved in gambling or betting, must not be involved in manufacturing or sale of non-halal items like alcohol, pork, weapons, must not be a conventional financial institution, must not be, thank you PK, must not be involved in entertainment activities not aligned with Sharia principles, right? That is the company, the activities in terms of company activities to determine the Sharia, whether you make the Sharia compliant or not. And then the second one is the debt ratio. So sometimes the company is doing manufacturing halal product, but they have a high debt ratio. So if the debt ratios exceed 33% of the total of asset, then it will actually be reclassified as non-Sharia. And the interest income, let's say for example, they have interest income in their business activities, it must not exceed 5% of total profit. And the account receivable must be less than 33% of total asset. So what is account receivable? Account receivable is refer to the amount that is due from customers or for goods that they have delivered or service that they have rendered, that they have actually delivered but has not yet paid by the customer. So it cannot exceed that 33% threshold. So type of ETFs and portfolio strategy, and the portfolio strategy when you're investing in ETF. So basically in the market, you have ETF stocks, you have ETF investing in commodity, you have ETF in sukuk, or people are familiar as bond. So sukuk is Islamic bond, and leverage. So for Islamic ETF, it only has stock, commodity, and sukuk. It doesn't There's no fund for leverage. So this is the ETF available in Malaysia. We have about 16 ETF in Malaysia, but only 7 is Sharia compliance. So the first is, okay, this is Dow Jones Islamic Malaysia Titans, okay, where they focus on blue chip Malaysian equity. This is their tracker. Let's say, for example, that you want to actually invest. So you just key in the track code. So they are investing on blue chip Malaysian equity. 25 countries, 25 company of largest Sharia compliant stocks. And this is the first Asia first Sharia ETF. So the second one is Dow Jones US Titans, where you actually have exposure in top 50 companies that is traded in US. So, and you have MSCI Malaysia Islamic Dividend, whereby they focuses on Malaysia high dividend Malaysian stocks. And then you have Southeast Asia Islamic Dividend. They track high dividend Sharia compliant stocks across Southeast Asia, Malaysia, namely Malaysia, Thailand, Indonesia, Singapore, and Philippines. So this is recently introduced in 2000 last year, Malaysia Enhanced Dividend Walk-Off ETF, which is targeting companies that both comply with Sharia compliance and offer strong dividend yields. What is unique about this fund is 50% of the annual income distribution will go directly to investors, and the remaining of 50% will be distributed or contributed to Yayasan Wakaf asset. So those who are not familiar about Wakaf, Wakaf is whereby you are giving up, your Wakaf mean an asset that you are, not to say donate, let's say the money that you give, right, that 50% of the money that you give will actually go to social costs. For example, the money that you give to the Yayasan Wakaf as the what we call pemegang amanah, or it can be called trustee. So the money that they will get, actually they will build schools, or they will build well. Yes, Mr. Sharon, we are getting dividend. Depends actually what you're investing, but you are getting dividend. The thing is, you don't own the stock per se. The fund own the stock. So let's say the fund own the stocks, and then they get dividend. Then the dividend will be distributed to all investors. Okay, but if let's say you're investing in gold, then there's no dividend, so you don't get dividend. Okay. So high dividend Malaysian Sharia compliant stocks, and a part of it will actually be given for social impact activities. So the next one is Trade Plus Sharia Gold Tracker, which is a commodity base. So it invests in physical gold hedge. And VP DJ Sharia China Asia is actually investing in Sharia compliant China Asia stocks. All right. So okay, now you have 7. How do you actually select your fund? Which fund that you actually want to choose? So this is, I mean, this is not absolute recommendation, but this is what I would recommend as an investor. First is you have to actually define your goal. Are you investing for income? Are you investing for capital growth? Or are you preserving your wealth? Which goals that you want? Are you going to invest a short time of period within 1 year? Are you going to invest in mid-term, let's say 3 to 7 years? are you going to invest long term? Let's say, for example, you are preparing for your retirement fund, or you are preparing for your higher education fund. So for your child education fund. And what is the value that you want to uphold? Are you risk averse? Are you someone that are looking for opportunities that is better than what you have right now? And the second one is you have to know your risk tolerance, which kind of investors you are. So generally, investors' risks are divided. I mean, risk appetite can be divided either conservative, moderate, or aggressive. So how do you know whether you are conservative, moderate, or aggressive? So you can actually just Google investor risk suitability. So that is a set of questions that you need to ask, and then they would, at the end of the questionnaire, they would actually some sort of determine what kind of investors you are. You have to actually know your risk investment before investing, because if, let's say, you choose aggressive investment, like equity, pure equity. Let's say you are, for example, investor A is 60 years old, at retirement age. Usually the risk profile is conservative because they don't have the energy and the time spent to actually accumulate. Let's say they get their EPF, 500,000 or 1 million. That money is accumulated throughout his working or her working career. Let's say that is about 30 years, 40 years of, let's say they start working at 20 and retire at 60, 40 years of working experience, and they accumulate 1 million. But if, let's say, suddenly he goes aggressive, meaning that he doesn't have experience before, or he have investing experience, but usually his investing experience, let's say he's a Bumiputra, his investing experience is only in ASB, tabung haji. Tabung haji is not even investment vehicle, or amanah hartana Bumiputra. And suddenly he wants to go aggressive to the stocks. Chances are he might lose money. And can he accumulate back or get back 1 million that he has accumulated for 40 years? Chances are he cannot, right? So that's why we see a lot of news saying that this person, every day, I noticed that I receive news every day that a teacher lost a few millions because investing in a scam, because they are excited with the return that the investment is offering. So you knowing your risk appetite at that particular time, because our risk appetite will actually changes. So when you are young, because we have more time spent, we might investing in a more aggressive. When we have kids, when we have commitment, you might want to actually moderately invest, because then at that particular time we have a commitment. So if, let's say, we invest heavily or we invest aggressively without a proper emergency fund, something happened to us, then we lost. We will actually experience losses, because we want to sell our investment, but the market is not doing good, and we are having paper loss. But at the same time, we don't have emergency fund. So what do? We decided that we are going to sell anyway, because we need the money. So usually people with high commitment will have a moderate, unless they have secured themselves with proper emergency fund, proper protection in terms of insurance, takaful, and they have knowledge. They have actually gained knowledge from young, right? And then when you are at the age like 60, 70, chances are you are conservative. You are just going to preserve the money for you to sustain until your demises or death, or you want to preserve the money to actually give the legacy to your children or grandchildren. So based on your risk tolerance, then you actually will allocate the previous fund based on your focus, whether you are aiming for income, you're aiming for growth, or you're just hedging or preserving your money. Okay. So this is again a recommendation of a portfolio strategy. So if you are conservative, you might want some income, you might want, but also you also want a protection. So income, you can choose Malaysia Islamic Dividend ETF, but for protection, hedging, you will actually choose gold ETF. So if you are a balanced or middle risk portfolio, you will actually choose 60-40 or 60-20-20. So 60 for equity, 20 for income, 20 for hedging preservation. Or if let's say you go for aggressive, then you will go 80 to 100% of your investment totally to equity, either in Malaysia or US or China, right? So investing in volatile market, what should you do? Right now, the market is very, very unstable. One time it's up, one time it's down. So what should you do as an investor? So now that you know that you are, which risk tolerance you are. So for example, you are a conservative investor. So your mindset is not the same as aggressive. Your mindset is not the same as moderate. It cannot have the same mindset because yours is only your prioritization is only for capital preservation, and you don't want a minimum stress. You cannot tolerate volatility, meaning for the new investor, well, volatility means the up and down market, you know that. So you cannot have that. You will have stress. So what you should do is you should shift to defensive ETF. So for example, just now, let's say for a conservative this fund, let's say previously you are investing in 50% Malaysian Islamic dividend to 50% gold. So during market volatility, you might want to reduce that lower. Maybe you want to go 30 to 70. Depends whether can you handle the stress. If you don't, then you have to go to hedging more. Okay. You have to increase exposure to cash-like instruments or Sukuk ETF. You have to rebalance your portfolio to reduce exposure to high volatility assets. If you have, let's say for example, if you have 5% in equity, you have your portfolio is 60 hedging, 30 income, and 10% in equity. So at that particular point, at the market downturn, you really want, you might want to exit the equity part, the equity portfolio, and go to hedging, right? And focus on income generating ETF with regular distribution. So what you should not do is don't panic selling, don't follow the trend, because investment is for a long time, not a long period of time, meaning that you are investing on the value of the company, you believe on the fundamental of the company, so you don't go panic selling. And as long as the investment, even though is showing losses, but as long as you don't sell it, it's just a paper loss. It will actually bounce back. So you don't overreact to market drops, and you don't taking on new high risk position, because suddenly you see, wow, there's a lot of equity are selling at a cheaper price. You want to take in, you become greedy and you want to buy more, but then you forgot that you are risk averse. So if you do that, then if the price kept dropping, then you will actually feel uneasy or you feel worried. Okay. The second one is moderate investor. So usually moderate investors, the mindset is you can accept some volatility. You want some growth more than putting your money in fixed deposit. You want more return better than fixed deposit. If let's say you are putting in ESB, you want more return than ESB. You want to have a mix of stocks that give income, high dividend yield. So what you should do during market volatility is you should diversify across sectors and regions. Why? Because sometimes, for example, when China is not performing well, some Southeast Asia might be performing well because let's say US China trade war. So the company might choose a supplier from Southeast Asia instead. They might find other alternative. So they are looking for Southeast Asia, like semiconductor. If they cannot get from China, they might choose Malaysia. All right. So if you diversify across regions, you diversify across sector. Remember during COVID, retails are not doing well because people cannot go out and buy. They cannot go out shopping. But healthcare is doing well. Warehouse, because people are doing online shoppings, are growing. So when you diversify, one sectors are not performing, another sectors will actually back you up. You maintain your core holdings and you avoid emotional trading. So during market volatility, some stocks, some fund are actually sell at a cheaper price. So usually, if let's say you are mak like me, right? Kalau things are selling at a cheaper price, we usually buy more, right? We stock up. But why? Because instead of buying 50, we are buying at 25 ringgit. So instead of getting one, we are getting two. So why didn't we do the same tactical strategy on stocks? Why do we feel, oh, the price is selling at a lower price, so I'm worried, I'm losing? You know that the company are fundamentally strong. Let's say TNB, or let's say TNB is a monopoly company. So why when the price drop, we are actually worried? Because people are still buying, people are still using, consumer sectors are still using, are still getting customers. So this is the time for us to do dollar cost averaging to take advantage of lower price. So keep a portion in hedge assets, which is like gold, sukuk, and review ETF fundamentals, not just price movement. So again, same like conservative, don't sell at the bottom during market fear, and concentrating too much in one market or sector. Because then if let's say, if you concentrate on one sector or market and your whole, that market is not doing well, that sector is not doing well, your investment portfolio will actually drop. So, so aggressive investors, what should do? So view volatility as opportunity, and you are not focusing on noises, what we call noises. You are focusing on long-term growth focus. So look for undervalued sectors and enter at attractive price. Continue accumulating through DCA, dollar cost average. Let's say, for example, if you just maintain investing 500 per month or 1,000 per month, or even 100 per month ETF, you can actually, if let's say 500 is much more something. So 500, even 100, you can actually still buy ETF if let's say you go through robo-advisor. So just keep investing. And if let's say you have a lump sum of money, So you might want to put in extra money during the dip, so you actually buy more. So maintain a long-term horizon. Consider temporary overweight in ETF. For let's say, for example, market really, let's say, recently, Iran and US war. Iran and is war. The country that shall not be named. I don't know whether allowed or not. So some market drops. So you might want to actually immediately move some of your fund to the hedge temporarily, looking for opportunity to buy at a lower price. So, and then stay updated on global and regional events that affect your ETF. What you should do is don't take leverage, meaning that don't take loan, don't become greedy and say, wow, this is buy. But you don't have the means to do it, so you take loans. Don't do that. That's very dangerous. Don't overexposure to one volatile market. So how do you start investing? So first, you choose a Sharia compliant broker, Bursa Malaysia. Okay, this is, let me go to this link. Let me share. I will click. Okay. Let me change. Okay. Share. Okay. So this is the list of Islamic broker that you can choose. Go to this website, bursamalaysia.com. So you go to Bursa Malaysia and then you go to list of Islamic broker. So this is the list of Islamic brokers available. So for example, Philip Capital. Okay. The company that I am attached to. So you can choose Philip Capital to open your brokerage account. Okay. Oh, sorry. Let me open the brokerage. Okay. So if you click on Philip Capital, so this is the landing for Philip Capital. You can open online, open an account. So this is an example. You can actually choose your own Islamic brokerage account that you want. So you just choose shares investors. Okay, choose here and then open, and then you might need to send documents. So once you open, you will actually have access to the trading on platform. So for example, and they might actually guide you on how to actually start trading. So for example, this is a sample of, okay. All right, so choose your brokers, any of the brokers that you might feel, comfortable to invest with, brokerage fund, brokers, and then you open an account, and then you will actually have access to the trading platform. So, so this is example. Different brokers will have a different way. The full screen is unavailable.
choose your desired order time and pay the desired price quantity along with your password. Place order by selecting the confirm button. Placing a trade on our Focus Volatile app is as easy as that. Download our Focus Volatile app on the App Store. That's all for this video. Stay tuned for our next tutorial.
Okay, that is just an example. Okay, sure. Correct. Okay. All right. So now you have, let's say you have start investing. So how do you actually monitor? So the performance of the fund that you actually selected. So the first is you can go through Bursa Marketplace, Portfolio 2. You can create an account on Bursa Marketplace. You can actually click the ETF that you have, that maybe before investing, you want to actually do a comparison. So you can actually add your ETF that you, out of that 7, the ETF that you want to choose based on your risk profile. So you can actually track the price movement, the return, and the historical charts. I won't go, I think I won't go too deep into this. Or you can also use information, investment information and service company like Morningstar and Bloomberg. You can just type in the ETF fund that you have selected. You can also track the price movement, returns, and historical charts from there. And what actually you are looking for? The first is you are looking for the price, the net asset value of the ETF. Whether the price is because in investment you want to buy low and sell high, right? So if let's say the price dip or the price decline, so is it a good time for you to buy, or is it for you to actually maintain, or is it for you to actually exit? Because you might have a certain target. Let's say if it drops 20%, let's say you are conservative but you have exposure in equity. Let's say it drops 20% of the price that you bought, then you say, oh, okay, this is below than my targeted, meaning I cannot tolerate anymore and I want to exit. Or if let's say you are aggressive, well, aggressive people say, oh, it drops 20%, maybe I want to actually top up more so that I can actually buy at a lower price. So it depends on your risk tolerance. NAV will actually tell you the price of the value of the ETF need. The performance is if let's say you want to make comparison with your other investment. If let's say you invest in purely on stocks, if you are investing purely, previously you are investing in unit trust and now you want to have exposure in ETF and you want to make comparison whether investing in the ETF is much more value, much more worthwhile, then you are doing comparison performance. Either you are comparing annually or you are comparing 1, 3, or 5 years performance. Let's say, for example, you are looking for long-term investment. So you are looking for performance more than 5 or 10 years. So you are looking at, oh, okay, this fund actually performing, might not be performing, it is performing negatively now, but over the years they are performing well. So maybe I can select this fund. So dividend history, you want to see how much income the ETF has generated, how much it gave to the investors. Is it a consistent, do they give consistent dividend? All right. And benchmark comparison, whether, remember, ETF track the indexes, so you want to see whether does it underperforming or outperforming the market, right? So underperforming means that the benchmark is up and then they are underperforming below the benchmark, so they are underperforming, and vice versa. The outperforming meaning they are performing above the benchmark. So what is my take-home message? In investing, you have to keep investing. Why? Because tough time never lasts. This is all the bull and bear markets of MSI, world bull and bear markets. If you see, for every bear markets meaning that market drop, market downturn. Bull means market upturn, market performing well. So in every bull market will be followed by a bear market, and usually it is longer than the bear market. So in 1973, the bear market is 21 months, but after that followed by 74 months of bull market. Maybe at that time I was not born yet. Let's say recent years. Let's say here, in 1991, there's a recession because due to oil price shock and rate hikes. Okay, here. So what happened is there is a bull of 9 months, but then the bear is after that is 94 months, followed by bull market downturn for 3 months, and then continued by 18 months. In 2008, 2008 is whereby there is global financial crisis in US because of the real estate, the bubble, the real estate bubble, right? So it goes to 5 months, go bear, and then it continue with 76 months. So you are seeing more and more short volatility, more and more market downturn, but you can also see more and more market upturn. So if let's say you are buying here and selling here, you are getting profit. But if let's say you go panic selling, the moment that it drops, let's say it drops here, and then you are saying, oh God, I cannot handle this, I'm selling it off, then you won't actually enjoy your profit here. All right. So this is a report that I get from JP Morgan, if I'm not mistaken, UK, Get to Markets UK. And this is in May, the report May. Okay, so tough time never lasts. So as an investors, if let's say you see the market downturn or the bear market as opportunity for you to actually buy low and sell high, then you are going to get benefit from it. And if let's say you are long term, it doesn't matter. Let's say you are 2025, you are going to experience for 25 years, you are going to experience 1, 2, 3, 4, 5, 6 bear markets. And you take this as a normal, and you just do as the strategy that I said, that you buy low, you do diversify, then chances are you are going to actually enjoy the profit now. And next one is there's no single winner. Why diversification is a way to go is because if you see world stocks market return, if you see all this world index, right? There's no one indexes that performing all the time. There's no, this is a proof that US doesn't perform all the time. Asia as Japan doesn't perform all the time. S&P 500 UK doesn't perform all the time. But if you make a portfolio, then you can actually diversify, because if let's say you do a portfolio, right? See, your portfolio will give a better performance if as compared as let's say you just focus on emerging market, or you just focus on Asia ex Japan without diversification. The same, if let's say you look at asset class, let's say you don't diversify in countries, but you have diversified in asset class. So you have asset class in equities, you have asset class in commodity, you have asset class in cash. So if let's say you you are so scared, you are so conservative that you say, I just want to I just want to preserve my cash. One is your cash will be eroded by the inflation rate. Your purchasing power would be weakened for every year that you keep your money in bawah bantal ke, ataupun in just money market or in just your saving account. So if let's say even if you think that you are safe because the money is still there, the inflation, your purchasing power will not be the same. And if let's say if you look at asset class return, here for 10 years annualized return, your cash will only give what 1.3% of return, as compared if let's say you are conservative but you have a mix of commodity, gold, you have a mix of bond, high yield bond. So chances are maybe you don't get 7.2%, but it definitely will be better than 1.3%. Okay, so either again diversify. If you can diversify with in the region or diversify within the country will be better. Diversify in asset class. So chances are, again, at one particular point, if let's say it's not performing, let's say the asset class is not performing, another asset class will actually perform. So remember, T3, tough times never last. There's no single winner. If you focus on one, there's actually no single winner. And the third one is keep investing. Keep investing whether it is upturn or is downturn. Because if you don't invest, you will still lose. All right. Okay. I think. Okay. I think that's about it. That's about it, Atira.
Wait. Okay. Uh, Thank you, Miss Azna, for your invaluable insight and wonderful sharing with us earlier. We will now proceed to the Q&A session. I encourage all attendees to submit any question you may have in the Q&A box. I will read the question and Miss Azna will address the question accordingly. Uh, okay, the first question is, can we know deeper about the list of company that being put in the exchange traded fund tersebut?
Yes, you can. So, Atira, can I
Okay.
show something? Okay.
Yes.
All right. So let's say for each fund that we actually invested, so we have what we call fund information or fund fact sheet. For unit trust, we call that as a fund fact sheet. Fund fact sheet is what we call surat beranak lah. It's a birth certificate which is actually tell all about the fund. I think I have downloaded one. Let me see. Okay, okay. You can actually if let's say, okay, we don't go to here. We don't I don't have downloaded one. Okay. All right. So if let's say you see this is EQ8 Dow Jones US Titans 50 ETF. So it invested in US and it invested in 50 Sharia compliant company in US. So this is, they call it fund fact sheet. And then the fact sheet is usually issued every month. So you can know when is the launch date, when is the listing date. So if you want to know, okay, so the distribution is dividend lah. So is it annually? Is it biannually? So in this case, it is annual distribution. Cannot see. Atira, can you see?
Wait.
Can see.
Can
Nampak
see.
tak?
Nampak? Saya nampak.
Nampak?
Yes.
Yes. Can. Alright.
Okay.
So you can also see their performance up until May 2005. So this is the performance. So this is their, you can see the performance. So year to date means from 1st January until now, until today. So 1 month is from today is 19, today is 19, right? Today is 19 June. From 19 May, 1990 June. So, oh, okay, sorry. This is not real time. Okay, this is from May. So May means 31st May 2025. So it's from 1st April. 30th April until 31st May. Like that. Okay. So 3 months, 6 months, 1 year, 3 years, and 5 years. So it since it's inception, meaning that if you invested in 2018 during the launch date, then this is the return that you will get. So if you see, right, hey, okay, now it's not performing. Now it's actually this one is the NAV is lower than it drops 3 and 3% negative. It drops. Negative means drops, right? So 3 months also drop, 6 months is a drop. But does it mean that this fund is not good? But 2018, 7 years. So over the long period of term, 7 years is about mid-term to long-term, right? And this is the index. They are actually performing better than the index that they actually follow. So what's not to invest in this fund? So the question is what company? Okay, again, you can actually find all the company, the Sharia advisor, like I say, see, this is Amani Advisors, the Sharia regulator, the company. So the sector. So this is the sector that they invested. IT, healthcare, energy, consumer staple, consumer discretionary, industrial, financial, materials. So financially, so they might invest in Visa. I think Visa is the financial sector they invest, but this must follow, like I said, the Sharia compliant screening. So Amani advisor will make sure that because financial sector is usually prone to be non-Sharia compliance because they usually involve riba. But Amani advisors as the Sharia advisor will make sure that the screening aspect is adhered to, that the business activities is adhered to, so that it will actually meet the Sharia compliance. So if let's say suddenly they change, they provide services that involve interest, then it is the responsibilities of the Amani advisor to take out Visa in Class A shares from the holdings of this. Okay, so I think some of the companies, I mean, for boys, they are more familiar with all this lah. Microsoft, Nvidia is gaming, right? Apple, Amazon. So highly, okay, this is what I call, sometimes if you don't diversify, you put everything, wow, because of the performance, 185, you put everything in you put all your hard-earned money in this EQ Dow Jones US Titans, and they are heavily in IT. 70% of their holding is in IT. So what happened if there's a crash in IT? Currently, we are into AI, right? Something, I don't know, something wrong with AI. I'm not an IT person, but something wrong in information technology sector. So without diversification, you will actually face the market drop, you will actually, NAV drop, you will actually face problem looking at your fund. Okay, so again, to answer your questions, it depends. You have to go to each ETF fund that you want to invest, and then go to find their fund fact sheet, and then you can actually bedah lah. You can actually go into depth what kind of investment that they have. Growth potential. So when they say growth potential, definitely is an aggressive. Kan? Okay.
Okay, for the next question, how do you make consistent return or money in a ETF investment? Is return in a ETF reinvestable or credited to investor?
Yes. How do you make consistent returns? Money in ETF investment. So if let's say you say that you want a consistent return, what kind of return are you saying? What kind of return are you looking? If let's say you are looking at a higher return, you might not have a consistent return. If you are looking for it, then you have to choose. If you are looking for consistent return, then chances are you have to actually choose a high yield or dividend income fund. Because dividend income fund usually choose company that give consistent dividend. So you are not looking for growth. So from your questions, you are saying consistent return. So are you looking for growth? So chances are, if you are not looking for growth, you might overweight, or you have more exposure in dividend income fund. But if you want some growth, then maybe your portfolio would be about 70-20 and 10 hedging, or 60-80. Dividend is reinvestable, and or you can actually lock your profit. Okay, next. Next, Satya. And next question.
Okay, so the next question is, in your opinion, which is easier for beginners, buying ETFs or unit trusts, and why?
Okay. For beginners, buying an ETF is much more easier because it's passively managed. You don't have to switch and sell. You don't have you have to monitor, but you don't have to monitor regularly. You maybe monitor periodically every 6 months, because it just track the index. But then as a beginners, you want to grow yourself, right? You want to be able to learn about investing, learn how to actually manage your portfolio. Because if you go to unit trust, and if let's say you actively manage, okay, one is passively managed, one is actively managed. Even unit trust can be passively managed, but usually if you let's say actively managed, because you regularly investing, right? You want to know which fund is better, because in the market there's a lot. Even in Philip, we have about 400 funds, unit trust funds, and you want to choose which sector, which fund. Yeah, and then you have to regularly see your agents. So, but then by doing so, you will actually know what fund would you like, because as an investors, you want informed investors usually have their own preferred investing assets. So some people like property, but they cannot afford to actually buy property yet. So they want to invest in real estate investment trust. I read Islamic REITs, right? So that is in unit trust. You want to invest, you want to have at one particular point, China, one fund in China can give you 60% return in 1 year. But it's very volatile. You are a beginner. So beginner means that you have, I assume, you have a longer time horizon. So you may start as with ETF because the selection is not done by you. But over the years, I think you need to bit by bit learn so that you can actually get a better return. So a better return will why a better return will actually help you is because it will achieve your financial goal faster. Let's say you're aiming 6%. So 6% will actually, with 6% return, you will actually require a longer period of return compared with rule 72, right? So you will actually achieve your goal, your money will actually double in 12 years. But if let's say you are investing in 12%, you got a consistent return of 12%, then you can achieve your goal within 6 years. So which one that you want to achieve your goal faster? 6 years or 12 years? So chances are you want to reach fastest, right? So, and that is, you will only be able to do it if you have the experience and you have the knowledge. So yeah, that's my take on that. Yeah.
Okay, I think that's the last question. So we would like to sincerely thank Miss Azna for taking the time to respond to the question asked. I hope that all of you have acquired new and useful knowledge from this session. May the insights shared today prove to be advantageous in your investment and trading pursuit.